The war between the United States and Iran that began in early March 2026 has had deep and far-reaching effects not just on geopolitics, but on global financial markets, especially currency markets. On March 2, 2026, when the US and allied forces launched strikes against Iran, global markets reacted instantly, and currencies were among the first to show volatility. Currency markets reflect the confidence that investors have in economies, and war creates uncertainty, fear, and rapid shifts in capital flows. In times of conflict, investors seek safety, and that rush for safety dramatically affects exchange rates. The most visible impact of the US-Iran war on currency markets has been the strengthening of the US dollar. Since the conflict began, the dollar has held firm and even gained against many major currencies. This is because the US dollar is widely perceived as a safe haven in times of crisis. When investors are uncertain or fearful, they sell riskier assets and buy dollars, US Treasury bonds, and other dollar-denominated assets. At the same time, currencies of countries heavily involved in or close to the conflict have weakened. For example, the Iranian rial plunged sharply in value, reaching new lows against the US dollar by late April 2026, as demand for foreign currency surged amid economic strain, sanctions, and halted exports. When people and businesses no longer trust the stability of their own currency, they convert it into dollars, euros, or other stronger currencies, pushing the domestic currency down even further. But the impact of war on exchange rates is not limited to the US and Iran. The euro, for instance, weakened against the dollar as investors fled to safer assets, and growth concerns rose due to prolonged conflict. When a major conflict affects global growth prospects, currencies of major trading blocs like the Eurozone can be negatively affected because investors expect slower economic performance and reduced foreign investment. Currency markets respond not only to the direct effects of conflict, but also to changes in energy prices that war causes. The Middle East is a pivotal region for oil exports, and disruptions to shipping routes, especially near the Strait of Hormuz, cause oil prices to spike. When energy prices rise, countries that import energy need more foreign currency to pay for that energy, which can weaken their own currency. For example, Japan, South Korea, and many European countries rely heavily on imported energy, meaning higher energy costs can put downward pressure on their exchange rates relative to the dollar. Additionally, during war, central banks often intervene in currency markets to stabilize their economies. They may raise interest rates to attract foreign capital or sell foreign reserves to support their currency. These interventions influence exchange rates, but can only succeed if markets retain confidence in the currency's underlying economic strength. Another key effect of war on currency markets is capital flight. Capital flight happens when investors suddenly move their money out of riskier regions into safer financial markets. Large institutional investors, governments, and even individual holders seek shelter in what they perceive to be more stable currencies like the US dollar, Swiss franc, or even some digital assets. This rapid movement of capital increases demand for safe haven currencies and decreases demand for others, affecting exchange rates accordingly. The war also affects smaller emerging market currencies. These currencies often suffer more during geopolitical tension because they are seen as riskier and because emerging economies have fewer tools to absorb shocks. Higher energy costs, disrupted trade, and lower foreign investment put additional pressure on these currencies, leading to higher inflation and reduced purchasing power at home. In some cases, investors react to war by turning to asset classes outside traditional markets, and that too can influence exchange rates. For example, during times of severe uncertainty, some investors have moved money into cryptocurrencies or precious metals like gold, which are sometimes viewed as stores of value when fiat currencies are volatile. While digital currencies do not yet rival fiat currencies in scale, these moves can reflect broader shifts in confidence and influence how currency markets behave. It's also important to understand the role of monetary policy in these situations. When war drives uncertainty, central banks may adjust interest rates to protect the economy. Higher interest rates can attract foreign capital, strengthening a currency, but they can also slow economic growth. Lower interest rates can weaken a currency but may stimulate domestic spending. These policy decisions directly impact exchange rates and can be triggered by prolonged conflict and its effects on inflation and growth. The global role of the US dollar has shown resilience even amid conflict. The dollar's dominance is supported by deep and liquid financial markets, with many global transactions and reserves held in dollars. This network effect reinforces confidence in the dollar when uncertainty rises, further strengthening it against other currencies. War also raises questions about the future of currency dominance. When investors feel that traditional financial systems could be disrupted, there is sometimes an increased interest in alternatives, including decentralized finance or non-US currency assets. These trends are still evolving, but they show how geopolitical tension can influence not just short-term exchange rates, but also long-term investor behavior. When markets perceive a ceasefire or potential peace, currency volatility often drops abruptly. For example, when markets sensed a tentative ceasefire hopeful scenario in early April 2026, some positive sentiment briefly stabilized currency pairs like EUR USD before volatility picked up again amid ongoing uncertainties. Expectations of resolution often reduce risk premiums and can strengthen weaker currencies temporarily, but sustained peace is needed for lasting effects. The timing of these reactions can also be linked to trading sessions around the world. When conflict news breaks during the Asian session, currencies like the Japanese yen and Australian dollar may move quickly as traders react. When the US session opens, the dollar often strengthens further as US markets absorb overnight developments and adjust positions. This intraday timing interaction shows how global currency markets are interconnected in real time. At the individual level, war-induced currency changes affect importers and exporters differently. Exporters in countries with weaker currencies can gain a temporary competitive advantage because their goods become cheaper abroad, while importers may face higher costs and reduced profit margins. Consumers also feel the effects through higher prices for imported goods and services, which can contribute to inflation. In summary, war affects currency markets through multiple channels: investor flight to safe haven currencies, capital flight from risky regions, energy price shocks, changes in monetary policy, and changing trade and investment flows. The US-Iran conflict has highlighted these dynamics with increased dollar strength and pressure on emerging market currencies. Understanding these forces helps investors and viewers see how global events ripple through financial systems and impact everyday economics. If you're watching this video, you now have a deeper understanding of how conflict, especially the US-Iran war, can influence currency values, exchange rates, and the global financial landscape.